Most people think debt is a personal problem, something that happens when you overspend or lose control of your finances. But debt isn't just a mistake people fall into. For banks and lenders, debt is one of the most profitable products in the modern economy, and the goal isn't always for you to avoid it. Sometimes the system works best when you stay in it. Debt is everywhere: credit cards, student loans, car loans, mortgages. In the United States alone, household debt has grown to more than $17 trillion. But that number hides something important, because every dollar of debt represents something else, someone making money from it. Most people think banks make money by safely storing deposits. But that's only part of the story. Banks make most of their money by lending. They lend money and then charge interest for the privilege of using it. That interest is where the real profit comes from. Today, the average credit card interest rate often sits above 20%, which means when a balance lingers, the interest grows surprisingly fast. You might assume the perfect customer for a bank is someone who quickly pays off their debt, but that's not actually the most profitable outcome. The ideal borrower is someone who always makes their payments but never fully escapes the balance. Month after month, the interest keeps flowing, reliable, predictable, profitable. Every credit card statement highlights one number: the minimum payment. It looks manageable, almost comforting, but what that number really does is stretch the life of the debt. If someone only pays the minimum on a typical credit card balance, it can take years, sometimes even decades, to fully pay it off, and the longer the balance survives, the more interest it produces. This is why debt has become such a massive industry. In the United States alone, credit card companies collect over $100 billion every year in interest and fees, late fees, interest charges, penalty rates. All of it adds up. And when millions of people carry balances at the same time, the profits become enormous. Modern finance makes borrowing incredibly simple. Credit cards arrive in the mail. Buy now, pay later options appear at checkout. Loans can be approved in minutes. This convenience feels empowering, but it also removes friction. And when borrowing becomes effortless, more people do it. More borrowing means more interest. Debt isn't just good for banks, it also fuels spending. Consumer spending drives roughly 70% of the US economy, and borrowing allows people to spend money they don't yet have. Homes, cars, education, entire industries depend on this cycle of borrowing and repayment, which is why debt has become deeply woven into the modern economy. None of this means debt is inherently bad. Loans can help people invest in their future or access opportunities they couldn't otherwise afford, but understanding the incentives matters, because once you see how profitable debt is, you start to understand why it's everywhere. Debt isn't just a financial tool, it's also one of the most reliable profit engines in the modern economy. And once you see that, you begin to notice something interesting. The system doesn't just tolerate debt. In many ways, it depends on it. If you want to see how the systems behind money and power really work, subscribe for more videos like this.